All right, let's be honest. Have you ever been staring at a stock chart and just wish there was a big flashing sign? Something simple that just screams buy now or sell, get out. A simple green light, red light system for the markets. Well, for a long, long time, a ton of traders thought they had found exactly that. But here's the million-dollar question. Does this so-called magic signal actually work, or is it just a trap for beginners? Let's dig in and find out. So here's what we're going to do. We're going to break this down into 5 parts. First, we'll look at the simple promise of this famous trading signal. Then, we're going to throw it into the data grinder and see what happens. After that, we'll figure out why these simple strategies seem to fail so often. Then, the fun part, how the pros actually use this tool. And finally, we'll zoom out and see how all of this fits into a way bigger debate about how money and markets even work. Okay, let's kick things off with that promise. It all revolves around this one super famous tool that, well, it seems to offer the perfect, almost magical answer to that classic advice: buy low, sell high. And that tool is called the Relative Strength Index, or RSI for short. So what is it? Think of it like a speedometer for a stock's price. It's not telling you the price itself, but how fast it's changing. It crunches all the recent price action and spits out a number between 0 and 100. Its entire job is to raise a little flag and say, hey, things are getting a little too hot over here. Or, whoa, things are getting really cold really fast. And this leads to the super simple rule that you've probably seen a million times if you've ever looked up trading online. The idea is, if the RSI number drops below 30, that means the asset is oversold. It's on sale. It's a bargain. That's your cue to buy. And on the flip side, if it shoots up past 70, it's overbought. It's way too expensive and it's probably going to drop. So that's your signal to sell. I mean, it sounds so simple, right? So clean, so logical, but does it actually work? All right, enough with the theory. This is where the rubber meets the road. It's time to see what happens when we take this super popular strategy out of the textbook and throw it at some real-world data. Let's put that simple buy below 30, sell above 70 rule to the test. The way we do this is with something called backtesting. And I love the way the YouTube channel Data Geek explains this. They say it's basically a time machine for your trading bot. You get to program your rules, send your little robot back in time, and just watch. Would it have made you a millionaire? Or would it have completely blown up your account? The best part is, you find out without risking a single actual penny. So what happened when Data Geek did exactly that? They took a year of Apple stock and ran the numbers. And the results, well, they're pretty eye-opening. The RSI strategy, it didn't just fail to make a ton of money. It got absolutely crushed by the simplest strategy in the world, just buying the stock and holding on to it. It didn't just fail to beat the market, it lost badly. And look, this wasn't just a one-time fluke with Apple stock. Over on Reddit, in the day trading community, one user took this idea and just went massive with it. They tested the exact same logic, but on 5,000 trades. And their conclusion, it was, and I'm quoting here, it failed hard. Let's actually look at the numbers, because they tell the whole story. A win rate of 42%? That means you're losing more trades than you're winning. It's worse than a coin flip. And the profit factor? 0.8? What that means is for every single dollar you risked, you only made 80 cents back. You don't need to be a math genius to see that's a one-way ticket to an empty trading account. So, what is going on here? Why is this happening? Okay, so how can a strategy that sounds so perfect on paper just completely fall on its face in the real world? The answer, it turns out, is that most of us have a dangerous misunderstanding of what oversold and overbought actually mean. So let's just lay it out there. The whole point of trading is to buy low and sell high, right? So why does this rule, which is supposed to do exactly that, fail so badly? That Reddit user had the perfect analogy for it. It's a classic in trading. You're catching a falling knife. See, when a stock is in a powerful, steep downtrend, that oversold signal from the RSI isn't a sign that it's a bargain. No, it's a sign that the downward momentum is insanely strong. Stepping in to buy at that moment isn't finding a deal. It's just sticking your hand out and getting sliced as the price keeps plummeting. And this really gets to the core of where so many people go wrong. The experts point out a few huge mistakes. People use the RSI all by itself, they completely ignore the bigger market trend, and they see those 30 and 70 levels as gospel, like absolute commands to buy or sell. You gotta remember, it's a tool, it's not a crystal ball, and it turns out most beginners are using this tool, well, completely backwards. So does that mean the RSI is just useless junk? Absolutely not. It just means we need to stop thinking about it in that super simple way. Instead, let's look at how the pros, the experienced traders and researchers, actually use it as one piece of a much bigger, smarter puzzle. Okay, and this is where it gets really interesting. Check this out. An academic study went back and tested this on 10 years of currency data. And that standard 30-70 rule, total loser. It lost thousands of pips, which are just tiny price movements in currency. But then they did something simple. They just tweaked the numbers. Instead of 30-70, they tried 35-65. And bam, it went from a massive loss to a huge profit. The takeaway here is incredible. There's no one-size-fits-all magic number. But honestly, the real secret weapon for pros isn't about finding the perfect numbers. It's about using the RSI for something completely different, called divergence. And get this. This is how the guy who invented the RSI, J. Wells Wilder, said you were supposed to use it all along. Divergence is simply when the price of a stock and the RSI indicator start telling you two totally different stories. And that disagreement, that can be a huge clue that the current trend is about to run out of steam. So here's how that works. It's pretty cool. Let's say the stock price keeps falling and makes a brand new low. But you look at the RSI and it refuses to go down with it. It actually makes a higher low. That's called a bullish divergence. It's like a secret signal that the sellers are getting tired. And the opposite is true too. If the price sits a new high, but the RSI is weaker and makes a lower high, that's a bearish divergence. It's a hint that the buyers are maybe losing their nerve. So let's try to put all these pieces together into a much smarter game plan. Step 1, you have to know what the bigger overall trend is. Is the market going up or down? Step 2, you start looking for that divergence we just talked about as an early warning sign. Step 3, and this is crucial, you never ever act on that signal alone. You use other charts, other indicators to confirm it. And finally, step 4, you wait. You wait for the price itself to prove to you that it's actually turning around before you risk a single dollar. You know, this entire conversation we're having, from that simple failed rule to this much smarter strategy, it's really just one tiny little piece of a much, much bigger debate. A huge argument about how the financial markets actually function at their very core. So on one side, you have a camp called technical analysis. This is where the RSI lives. These guys believe that human emotions and behaviors create repeating patterns in the market, and if you can spot those patterns, you can predict the future. But on the other side, you have the efficient market hypothesis. This camp says, nope, the market is basically a random walk. They believe all known information is already reflected in the price, so trying to predict it is a fool's game. And what's so cool is that our RSI story gives ammo to both sides. The failure of that simple rule, that's a huge point for the random walk team. But the fact that a more nuanced approach can work, well, that's a point for the technical analysts. And that brings us right to the final, biggest question of all. What does this whole journey with the RSI really tell us about the nature of the market itself? Is it a giant, complex puzzle that, with enough skill and the right tools, you can actually solve? Or is it all just random noise, a random walk where we're desperately trying to find patterns that aren't even there? Because really, how you answer that question, well, it changes absolutely everything.